Next, we're going to look at calculating depletion. Depletion is calculated by taking the acquisition cost of the resource divided by the estimated units of production. So let's assume we bought a gravel pit for $1 million. We have a piece of land that has a lot of gravel in it, and we pay $1 million for it. And we have used engineering techniques, and we estimate that there's a possible yield of 2 million yards of gravel in this pit. So then we divide the $1 million by the 2 million cubic yards, and so for every yard that we mine out of the pit, we charge 50 cents per yard to expense. At the end of some period of time then, the asset will be fully depleted, if our estimates are correct. Probably they're not. We're going to have more than 2 million yards in there, or less than 2 million yards, but this is the best possible estimate at the time of acquisition. Next, we want to calculate gain or loss on the sale of an asset. This can happen at the end of the useful life of the asset, or it can happen before the company has reached the end of its useful life. They may sell it in the interim sometime. Let's assume that the cost of the asset was $50 million, and the accumulated depreciation at the end of year 4 is $20,000, so it's not fully depreciated. We say that the asset has a book value of $30,000, which is the original cost less the accumulated depreciation. And if you look at a financial statement and look at equipment or machinery or other assets of that type, what you see on the balance sheet is the book value. It's the acquisition cost less the depreciation. So they're able to sell this asset for $40,000 at the end of year 4. So there is a $10,000 gain. Our basis is $30,000. We sell it for $40,000, so we get $10,000 more than the cost we still have remaining in the asset. Now, if they sell it for $25,000, they're going to be selling at a loss because they're only going to get $25,000 for an asset that's on the books for $30,000. Next, let's talk about capitalization policy. Each company has a capitalization policy. This refers to the cutoff at where they consider the item being purchased as an item to be expensed in the current year as versus an item to be capitalized and depreciated over its useful life. This can be as low as $250 or can be as high as several $1,000s depending on the corporate policy. Usually any item with a life of 1 year or less is not capitalized. Also, short-term or short-life items might be expensed, such as laptop computers or something of that nature that basically becomes obsolete very quickly. Improvements that are made to an asset over its life that have a life of over 1 year should be capitalized. So let's say we have a building and it had a 40-year life, and at the end of year 20 we had a new roof. Then we need to write that new roof off over the remaining life of 20 years if we think the roof will last for 20 years. So an asset may have more than just its acquisition cost as a component. It can have the cost of the acquisition plus any improvements that have been capitalized to it over the life of the particular asset.